produzione Corax, social media company.
Professor Krugman, welcome to my podcast, The Bull.
Well, thank you for having me on.
First of all, let me thank you on behalf of some tens of thousands of people, because your presence here today is a rare opportunity. And before we start, let me celebrate together your last achievement, because after being a renowned economist, winner of the Nobel Prize in economics, professor at MIT, Princeton, and CUNY, you are a successful newsletter writer.
Yeah, it's an interesting departure. I was writing, obviously, for a newspaper, for the world's greatest
the New York
newspaper
Times.
for many years, but this is another kind of thing to do. And it's challenging because there's no guaranteed readership, right? You have to earn your readers every day. So I'm having fun, although I am working awfully hard for someone at this point in life. But anyway, it's an interesting experience. Hopefully, I'm doing some good.
Did you expect that your Substack would become such a massive success?
I thought it would get a number of readers. I'm actually a little surprised at how many people are contributing to the paid readership, and the breadth of the readership is really surprising. I was wondering whether I would get so many people willing to look at charts and tables, out there in the wider world. So it's an interesting experience. It's a whole new world. I mean, in a lot of ways, we're just seeing things changing, and I'm not prepared to. Again, I'm willing to. It's a new venture. I'm willing to experiment, although I'm not ready to start doing TikTok videos.
So far. So please do me a favor, subscribe to it, because you can read a lot for free, but it only takes $5 a month to have full access. And thanks to Mr. Trump and his effort to weaken the dollar, bad news for us as an investor in the S&P 500, but good news for US-based subscription, which cost us less in euro. So it's worth the price.
Well, okay. Anyway, so yeah. All right.
Okay. Let's start. There's a lot I'd like to cover, but I have to make some choices. And I'd like to start with the state of the economy. One of the biggest buzzwords in 2025 is the K-shaped economy. Basically, the rich got richer while those belonging to the low middle classes feel worse off. In the US, we have this contradiction with the US stock market at all-time high, GDP growing maybe 4% in the fourth quarter 2025, while on the other side, inflation is sticky and it's harder than ever to find a new job. Is the US economy running hot, as the president claims?
Okay. The data are unusually confusing. To a certain extent now, you can pick your indicator and it will tell you whatever story you want to hear.
Yeah.
Even the K-shaped economy, the data are not all that clear on it, but I believe it must be true because the subjective indicators are very clear. You can really see that if we look at what kinds of retail sales are holding up, it is high-end products. And if we look at which restaurants are full and which are empty, it's not the fast food is suffering badly and high-end dining is doing well. And of course, we have the stock market, although it is kind of important to be aware. I certainly have tried to tell my American audiences this, that stock markets are up everywhere. And the U.S., the S&P 500 is up less than the Euro 350, right? I mean, it's actually, stock markets are up more in Europe than they are in the United States. So this is not a uniquely U.S. phenomenon. But it's very clear. I mean, the most telling thing, I would say, the most negative aspect of the economy is that although the overall unemployment rate has not surged, it's become extremely difficult to find a job. That the duration of unemployment in the United States, if you've been laid off or you're a young person just entering, the time it takes to find a job just keeps on going up. People asked, are jobs plentiful or are they hard to find? That indicator has plunged. So we're a frozen economy, which is people who are staying in their current jobs aren't yet suffering all that much. But again, if you have been laid off, if you're young, it's really bad. And this is not a happy situation for the economy.
So it's not a golden era for the U.S. economy.
Oh no, I mean if we don't yet know what the next GDP number will come in as, but if it does come in really hot, I think that will say more about the limitations of GDP as a measure than it will about what's actually happening in the economy.
What do you think about the latest non-farm payrolls data? The number was very high, but the market seemed suspicious about the number and its trustworthiness.
Yeah, I mean, there's some conspiracy theorizing about them cooking the numbers, and that's not true. That's not saying that they wouldn't, but if they were trying to do that, we would know about it. Still, that's not an issue. What's really people like me have spent years trying to explain that monthly job numbers are very noisy. I mean, even the U.S. Bureau of Labor Statistics, when it releases the number, it actually releases an error band, a confidence margin, a 90% confidence interval. So yeah, the headline number was 130,000 jobs, and the confidence interval ran from 8,000 to 250,000. Right? I mean, this is not a number that you want to go to lead into very heavily. And if we look at the 1 year change, it's actually really disappointing. So this was just not it wasn't telling you very much. And the markets, I think, actually mostly discounted it, saying this is not a trend.
Yeah, thank you. Let's talk about tariffs and trades, because this is the big one in today's global economy, because we don't really know the worldwide effect of what has happened in 2025. But coming from this, I have two questions. Number one is, what is most commonly misunderstood about the U.S. trade deficit that started all of that? And second, what are the most likely consequences of raising tariffs in response to that?
Okay, so the trade deficit, what basically nobody outside economics understands is that trade deficits aren't about who's winning and who's losing. In many ways, if anything, it sometimes goes the other way around. The balance of payments always balances. If you are running a deficit in trade, it must be because you're actually selling more assets to the world than you're buying. And so if you're a country that's an attractive destination for investment, you're going to run trade deficits. And that's basically the story of the U.S. trade deficit since the 1980s. That basically the U.S. has been an attractive place for people to invest. And so, the mechanics of how that works out are complex, but it's basically saying that we run a trade deficit because people have wanted to invest in the United States, and it doesn't make us poorer. It's the flip side. And so the trade deficit really shouldn't be an issue, or there are situations in which it can be an indicator that you're having problems, but it isn't, in fact, for the U.S. So there's a lot that's going wrong with the United States, but the trade deficit is not on the list. And tariffs, are not and will not eliminate the trade deficit unless the tariffs come as part of a general package of policies that make America look like an unsafe place to put your money, which may be happening, but that's going to take some time. The tariffs have, so we have, there are larger implications, but one thing that I've always found, I do international economics, international trade, international finance have been my whole life. And one of the things you find out is that the people who are most hyped about and obsessed with international economics are exactly not the people who work on it the most. Because if you work on it, you have some sense of the limits. I mean, it's important, but it's not as important as many people seem to believe. So I'll give you a number here. So we, as best we can tell, actual effective U.S. tariff rates have gone from a little less than 3% to something like 10 percentage points higher on average. That's a lot less than the headlines we're seeing, and that's because there are a lot of carve-outs.
Yeah, there are exceptions.
If you're bringing in iPhones from India, there's no tariff. If you're bringing in most products from Canada or Mexico, you can get an exemption. Just overall, what on paper looks like a 15 to 20% rise in tariff rates is in practice more like a 10% rise. Imports in the United States are about 11% of GDP. So if we're asking about prices, how much would we expect prices to rise? And the answer is a little over 1%. And in fact, in detailed looks at the numbers say that most of that has happened already. Some of it has still been swallowed by companies, by firms not willing to pass it on to consumers, but we've seen it. And it's not, if you say, where's the runaway inflation? Well, if you actually did the math, you didn't expect runaway inflation. You expected an impact, but not a huge one. And that's kind of what we're seeing. It is reshaping world trade. In the case of the United States, what's really kind of striking is we're importing substantially less from China, but more from other places, which is, by the way, means that we're shifting from low-cost sources to high-cost sources. So that's actually not a negative. But I think the bigger issue here is that we have torn up all of the rules. That for 60 years now, we've had a global system of rules. I guess it's 70 years now since the GATT, which gave, didn't always say that trade was free. We only gradually got to a relatively low tariff world, but it meant that countries and businesses and people could make plans based on the idea that there were rules, that you couldn't just have the United States couldn't throw on huge tariffs on Brazil because we didn't like their political decisions, that sort of thing. And the United States, although it was for most of that period the by far the largest economy, did not chose to obey the rules. So we were good citizens of the global order that we created. It wasn't always a benign global order, but anyway, we did follow our own rules. And I was in the U.S. government a long time ago. I spent a year in the Reagan administration, believe it or not, and there would be meetings in which somebody would float a proposal for some trade intervention, and the people from the U.S. Trade Representative's office, which does trade negotiations, would say that would be GATT illegal. That would be against the rules. End of discussion. Ronald Reagan was not the most globalist internationalist president, but within his administration, if the United States had made an agreement, we kept it. And what's happened is all of that is gone. Now, the good news is that that's really the United States doing that. We're not. A lot of people were worried and still are somewhat worried going forward that this means chaos in international economic relations generally. And we're not seeing that so far. I've written about the EU reaching a trade agreement with India. And aside from the content of that, it was just so striking to see an actual trade agreement, which actually has text and was actually negotiated in a conventional way, as opposed to the president tweeting something out at 3 a.m. So as far as we can tell, Europe and India, and even in its own way, they're not very law-abiding, but even in its own way, China are still operating on a rules-based system. So we don't know whether U.S. chaos will eventually become the norm, but so far it's not happening.
Do you think there's, I'm afraid about the question I'm going to ask you, but do you think there is a rationale behind the idea of threatening partners with tariffs to obtain things that should sometimes reinvigorate manufacturing in the US, or making other people paying for the US debt, or pick your favorite one.
Yeah, okay. I'm not a free trade purist. And in fact, our system wasn't free trade purist. When Trump announced we're going to demand reciprocity, actually, reciprocity has been how the whole system has worked. Actually, in the United States, going back to the 1930s with the Reciprocal Trade Agreements Act, we've always negotiated lower tariffs in return for other countries lowering their tariffs on U.S. products. So but that remains both as a matter, to some extent, of economic policy and of the political economy. You have to. We are going to be using tariffs as a way of enforcing rules. As the goals are not simply economic efficiency, and in some cases, I'm all for that. I mean, I actually do believe that the EU's anti-coercion tool is something that you are going to need to use, because China is a real problem, and the flood of Chinese goods is going to be unacceptable. So you do need to do stuff. Now, the thing about U.S. policy is it has been just the interventionism per se is not necessarily a bad thing, but the incoherence is a really bad thing, and also the omnidirectional nature. I mean, if the United States wants to get genuine, better trading relations, wants other countries to stop doing things that they were not supposed to be doing, and China is not innocent here.
Sure.
But that's okay. But if we're going to be throwing tariffs around to try to change Brazilian politics, or because we're mad at Canada for accepting some Chinese electric vehicles, or we want the Europeans to let us have Greenland, that's both destructive, and it's also delusions of grandeur. The United States is an important part of the world economy, but we are not. We are not dominant, not in today's world. And the idea that we can get everybody to give us everything we want because we will threaten tariffs, it's just not going to happen. And there is a fundamental misunderstanding also of what tariffs do in the 21st century. We're not the 19th century economy where the United States go back far enough where we exported wheat and imported manufactured goods, and tariffs built up U.S. manufacturing. We're now part of these complex international value chains where tariffs actually probably hurt U.S. manufacturing because they raise the cost of inputs. And so, not surprisingly, the U.S. has lost manufacturing jobs every month since Trump threw on his big tariff slap back in April. And that's it's just not going to work as announced. And if you ask, well, what is the underlying strategy? My question is always, if you think there's an underlying strategy, who do you think is doing this? I mean, we know who the personnel are, and there is really nobody in the U.S. government who, with a position of authority, who is thinking this through, is even capable of thinking this through. This is really just the 3 a.m. whims of the man in the White House.
Yeah, it's a busy job as a social media manager.
I'm sick of it. I want to go back to actually talking about debatable, coherent policies, but unfortunately, that's not the world we live in.
No, okay. You mentioned earlier the EU affair with Greenland, and if I'm not wrong, you somehow suggested the EU to push back the bullying activities, and the idea here is that, okay, we can push back, we have the bazooka, we have a lot of treasuries, we are the biggest creditors to the US government, but it could end badly for us, for the European, because we are not sure we will be able to stand such a tit-for-tat approach. What do you think about it?
Well, If we look at trade between the U.S. and the EU, first of all, it's almost balanced. I mean, the EU runs a surplus on goods, but the United States runs a surplus on services, and it almost nets out. So, just in terms of damage that can be done, yes, the U.S. can do more damage to Europe with tariffs than Europe can do in reverse. But on the other hand, Europe can clamp down on U.S. service exports. I don't know that we're going to get to that point, but in terms of who has the leverage, that really isn't clear. And there just has to be a point where you say, look, this is just not legitimate. If Europe stands for anything, it stands for the territorial integrity of its members, and the U.S. wanting Greenland for no very good reason, right? If on all the national security concerns, the U.S. already has basing. We have a base, and we have extensive basing rights in Greenland, and this is until just like yesterday, Denmark was one of our closest allies. So this is crazy, and I actually think the effect so far has been salutary because much of Europe has taken a stand. I think it was actually extremely impressive that multiple countries, put some military forces into Greenland. Now, that was all symbolic. This is not a military force that can repel a U.S. invasion.
Sure.
It's a tripwire that says to the United States, if you want to if you want to just completely break the rules, this is going to be really explicit. You're not going to just march in without any opposition. And the United States has basically backed down. So, and this is maybe a defining moment. We're going to need a lot. And if I had to say, what am I hoping for in the world order? I'd like to see the United States turn sane, but that's not going to happen at minimum for 3 more years. So, waiting, in the meantime, the main thing we need is for Europe, which is a superpower but doesn't act like one, to start behaving, standing up for defending what it stands for. And this was a small step in that direction.
Do you think that the EU finally shows some spine in the Greenland affair?
It shows some spine in Greenland. I have enormous mood swings when it comes to Europe. I mean, on the one hand, we have Europe doing the right thing on Greenland. We have Europe, not as much as we'd like, but to a much greater extent than people realize, stepping up on Ukraine. I mean, Ukraine is now entirely relying, it's entirely European aid. The United States is completely indicated.
Yeah.
And on the other hand, we have people like incredible remarks by some European figures, Mark Rutte and others, that Europe can't stand up to Russia alone. And my God, I mean, the European Union, even just the 4 big European economies combined, have several times Russia's GDP. I mean, this is crazy. The idea that Europe is a weakling is entirely a choice, and hopefully that choice will end.
Sure. Coming back to the idea of imposing tariffs for whatever reason, what is the difference in terms of outcomes and possible side effects between imposing trade barriers and subsidizing the economy, as Joe Biden, for example, did with the CHIPS Act?
Okay. I mean, textbook economics says if you want to promote an industry, promote the industry. Tariffs have all kinds of side effects that traditionally was, they distort consumer choice, but also now if you impose a tariff, you raise costs for downstream industries, whereas if you just subsidize, you don't. And there are definitely industries that should be promoted for national security. Most of my life, trade economists, I'm afraid myself included, have kind of treated national security as a disreputable argument. Oh gosh, only scoundrels, national security is the last refuge of scoundrels. But now we live in a world where China has used embargoes on rare earth exports as a tool of power diplomacy. We live in a world in which it turns out that large-scale conventional war in Europe happens. So these national security concerns are real, and clearly the West needs its sufficient base of rare earth production. It needs a sufficient base of semiconductor production. So there are industries that we really need for national security. The technological, the cutting edge industry argument is, it's always, we're never sure which industries are crucial, but it's not hard to make the case that there's certainly a precautionary motive for subsidizing some industries. So all of that makes sense. But if using a tariff is an ineffective relative to subsidies, it's an ineffective way of promoting industries that often backfires because of the downstream effects. I mean, actually, if you look, the United States has just treating U.S. policy at face value, but the U.S., we have an arguable real strategic interest in both national security and technological in promoting U.S. production of semiconductors and other advanced technology goods, which we were doing. Now we're trying to do it, or they are trying to do it with tariffs, and immediately it turns out that we basically have a carve out on tariffs for everything that's going into the data center build out.
Yeah,
and because we want to, but then what happened to promoting U.S. semiconductor production? So now, if we were subsidizing it, if we were just doing the CHIPS Act as we were a little over a year ago, that wouldn't be an issue. We can subsidize semiconductors while at the same time allowing the AI superscalers to do their investment. So this is kind of a real life place where we immediately see why subsidizing is better. And if you say, well, subsidies cost too much, well, tariffs cost more. It's just that the cost is largely indirect, falling on consumers and downstream industries. So far better. I mean, I'm not a free trade purist. I'm certainly not. I wouldn't say enthusiastic. I was a strong supporter of the Biden administration's industrial policy because I thought the case was clear, and it's a riskier, more dangerous world in which preserving and promoting domestic capacity in some industries does make sense, in which Article 22 of the GATT turns out to be relevant after all. But that's a world of difference from what we're actually doing now.
Yeah, sure. Thank you. Very, very insightful. Moving from trade to monetary policy, and the hyperscalers are somewhat at the intersection of the two themes. One obsession of the current administration is interest rates, and there's a narrative going on according to which AI-driven productivity boom would be deflationary. Therefore, there is the case for lowering rates, but I think you are skeptical about this argument. Could you please explain why and what the administration is looking to achieve by lowering rates with the economy running hot?
Okay, so the first thing, as with everything, if you believe that there's a coherently thought out policy here, that there are experts inside the administration devising their monetary strategy, you're deluding yourself. I mean, and particularly, we actually know more about what's going inside this president's mind than ever before, because he goes, sometimes
he tweets anything.
Sometimes puts up 100 posts in the course of a night. So we know what's on his mind, and it's very clear that he just thinks of interest rates as being like a prize you win in elementary school for scoring well on a quiz, right? I have a great economy, therefore the Fed should cut interest rates. And so, all right. To the extent that there's a serious argument, it is, do we think that, other things equal, rapid productivity growth reduces inflation? Yes, and it's by no means guaranteed that we're actually going to see rapid productivity growth, but if we did, it would mean that, other things equal, we could have lower inflation. We could have lower inflation for a given amount of labor market tightness, roughly speaking, which did in fact happen in the 90s, at the end of the 90s.
Yeah.
But that's that's famously Alan Greenspan bet on that effect and was right. Wrong about a lot of other things later on, but he was right about that. But it did not actually cut interest rates because what a technology boom does, it may raise productivity and may in that way be a disinflationary force, but it also increases demand because there's a surge in business investment.
Yeah.
And the monetary policy response should, by and large, be actually to raise rates, not cut them, because although you can run the economy hotter, the investment boom wants the economy to get even hotter than that. So you end up raising rates to at least a little bit to curb inflation rather than feeling free to lower rates. And that's actually what happened in the 1990s, which in many ways is not a great parallel with what's happening now, but still, to the extent that it's there, it's a widespread belief that Greenspan cut rates. He didn't. He refrained from raising rates as much as some people thought he should, which is not at all the same thing.
Yeah, they were higher back then.
Oh yeah, interest rates were higher through the late 90s than they are today. Long-term interest rates were substantially higher than they are today. It was not. I mean, inflation was low. The economy was running hot, but that's. It would have been overheating massively if Greenspan had cut interest rates by 300 basis points the way Trump wants them cut now. So it's a misinterpretation of the lessons and a lot of misremembering. I mean, it's amazing how helpful it can be sometimes to just pull up a chart of the history of interest rates and say, well, what actually happened there? Actually, when I did that, I was saying, wait, why did why did Greenspan cut rates in 1998? And having been around for a while, oh yeah, that's the long-term capital management crisis.
Yeah, of course.
But but by and large, he did not cut rates. And so this is all it's a lot of selective misremembering of the past and selective. You're picking up some of the logic of a technology surge, but only some of it. And if we take it all together, it just doesn't make the case for lower interest rates.
Yeah. Upon Kevin Warsh's nomination as the next Fed chair, the markets reacted as a hawkish new Fed chair will step in. Do you buy into this narrative?
Okay, what we actually know about Warsh is that he's hawkish when a Democrat is in the White House and has been dealt with when a Republican is in the White House. Now, that's not encouraging, and I think people are misinterpreting because he was actually we've been hearing from Warsh a lot since about 2010, and for most of that period there was actually Democratic administrations, and he didn't say much during the first Trump administration, but he's turned massively dovish now in what he says. Now, what he will do, it's at least possible that once actually there in the chair, that he will suddenly sort of throw open his street clothes and reveal that he's an anti-inflationary superhero underneath, that he's a conventional central banker. It's quite possible that's. I have no idea. I mean, but it's possible that he will, in the end, become much more conventional than he's currently sounding. Don't know. And he has. One thing he has consistently been against is the big central bank balance sheet. He doesn't like the fact that the Fed has so many assets, which makes everyone a little uncomfortable. But I think all of that actually just matters less than people imagine. A lot of people, the Fed expanded its balance sheet. The Fed bought a lot of assets in an attempt to get some traction when short rates were zero. There's the evidence that really did get traction is very weak. And maybe it's there, but it's not strong, which means that shrinking the balance sheet wouldn't do very much. And if we ask, much of the Fed's balance sheet expansion took place in periods of financial crisis when actually all hell was breaking loose and they were just stepping in because the markets had frozen. And if they were to reverse that policy during financial crisis, that would be a serious thing. But to sell off a trillion or two, trillion here, trillion there, and eventually you're talking. But anyway, under normal circumstances, the impact would probably be very modest. So that's not a big hawkish move.
Yeah. Earlier, you mentioned the 90s and the dot-com boom during the Greenspan time. And a lot of comparisons have been made between that period and this AI boom. Hope there's not AI bust in the aftermath, but who knows? Anyway, the market seems unbeatable, and upon the Liberation Day, there was a bloodbath, but the market basically shrugged off anything. Do you think that it's more about economic resilience, amazing earnings, or just complacency?
Oh, well, some complacency. I mean, if I were to say that market plunge after Liberation Day was a sort of perhaps defensible panic, partly because the policy was so crazy that you wonder what other crazy things would happen. But the fact of the matter is, most of the rest of the policies so far, they're crazy but small. So trying to cancel all wind power projects for stuff like that matters, but it doesn't matter all that much for the macroeconomics, at least so far. And as we were saying at the beginning of this talk, the international trade is less important in a lot of ways for the economy than people tend to imagine. Now, the market, profits are continue to be high. The market is to some extent reflecting that. Also, for whatever reason, the whole world is kind of risk on, as the news jargon has it. As I say, stock markets are up everywhere, even more outside the United States than inside. The question of whether AI, there are actually two questions about the economic significance. One is whether it's really going to deliver in terms of productivity and all that. And I'm starting to realize that there's an important division there between kind of general public-facing use of AI, which is clearly overhyped. I mean, it's the kinds of stuff that I encounter. I have to turn AI off in my search engine because it's just problematic, and as we all know, it fantasizes. I mean, it's great to look up at myself and discover all these papers cited that I never wrote. So that stuff is, and it's destructive. I mean, I'm not actively teaching anymore, but which means I'm not actually receiving student essays that were clearly written by ChatGPT, but that's happening all over the place now. But on the other hand, there's the sort of less visible stuff, largely sort of ChatGPT versus Claude. And people who do coding say that this really is a big thing. And there are reasons for that. It's not just that what's sexy and glamorous tends to be junk and what isn't is more real. It's also, as this has been explained to me, when you're training these models, when you're doing software, there's a clear gradient. It either works or it doesn't. And so you get to train them so they actually produce useful results, whereas the sort of stuff that lazy students are doing is not. So this is, and it may be that in software, people are saying that it's a big deal already, and I don't know how broad that is, but there is an echo there of the tech boom in the 90s, where there was a lot of hype over pets.com and all of that, which a bunch of companies went bust. But there was actually a very real productivity surge driven by the things like Walmart using networks, often local area networks rather than internet. But anyway, Walmart using networks to manage inventory. So we actually look at the productivity surge back there. A lot of it was in very mundane, not public-facing areas where it turned out that IT made a big difference. And we may be seeing that again, that while we're all looking at the AI-generated slop infesting social media, that meanwhile in the background, companies are using AI, what we're calling AI, but are using these models to do prosaic but important tasks under the surface. And now the other thing about the IT boom is that it was actually it was serious. The productivity impact was really there, but it was also not a sustained takeoff. We got about 10 years of good productivity growth out of the IT boom. And a lot of people were expecting that to continue, and it didn't. It faded out. So a warning about not being too enthusiastic, even if we do really see big results. And of course, the last point is having a technology that does real stuff is not a guarantee that the companies investing in that technology will actually make lots of profits. So, and my last big failure to have a parallel this time around is, why were the ads, the technology ads, so much better in the 90s? Actually looked at the AI ads during the Super Bowl. They were really dreary. And I want the old, showing my age here, but I want the old ads with William Shatner and all of that from the tech boom.
Yeah, it's questionable who's going to make money from AI, because we know who is spending it, but it's not clear how to monetize it.
Yeah, I mean, there's history can be helpful, but also misleading. A lot of people are I think people are talking about the California gold rush, where everybody went bust except Levi Strauss, which supplied the pants, the trousers. And they're saying, well, NVIDIA is the Levi Strauss of this, but we don't know that. They're producing very high-end chips for general purpose models, and maybe the future actually belongs to more special purpose chips being produced by Chinese companies. So we don't really know. We don't know that.
Yeah. Another big theme is clearly the US dollar. For several reasons, both political reason and financial reasons, on January the 30th, upon Washington nomination, we had this crazy day on the markets with gold and silver plummeting as they only did during 1980 before that. And it seemed it was all about this idea of the debasement trade. So somehow people are worried all around the world that the dollar will fall in value, will lose its dominance. And so they somehow try to find a hedge in metals. And there's a lot of momentum enlarging this movement, of course. What do you think about this whole idea of the debasement trade? Is it overstated, or is there something true about it?
Oh, it's overstated. Two things. First, if you're worried about the dollar being replaced as the global currency, that is not going to happen anytime soon. Anybody who says that the renminbi is going to step in, my question is always, when do you think that Mandarin will replace English as the international language of business? Because those are very closely parallel. That's famous old essay by Charles Kindleberger. And it's just that there's so much momentum, so much inertia, I should say, behind the use of the dollar in international business that a replacement is just not something that could happen, even unless the United States really goes wild, unless we start to have, unless we have a Turkish monetary development and inflation goes to 80%. People are going to keep using the dollar, and there's a real lack of alternatives. The renminbi is clearly, with capital controls and everything else, is not suitable. The euro might have been suitable, but it's the European bond markets are still differentiated. It's not a deep enough market for any one country, and the idea of Bitcoin or something like that those are completely unworkable. So actually, the big risk if the United States really goes crazy is not that something will replace the dollar, but that nothing will. That we end up with international monetary chaos, which imposes a lot of sort of friction, but not abruptly replacement. And we're not imminently at risk of that, even with the U.S. the current U.S. administration has so far been able to just do whatever it wants on tariffs, which is a result of some. The weird structure of U.S. trade law, which gives a lot of discretion to the White House. It doesn't have anything like that on monetary policy. So even if Kevin Warsh turns out to be completely obedient, which is not certainty, he's only one vote.
Yeah,
and so I don't think monetary policy is going to change drastically. So the debasement trade I think there's room for some debasement trade to say, look, the United States is kind of looking kind of weird. And I would say, actually, I would be more concerned about direct investment in the United States than dollars. If you're going to open a factory in the United States, you do have to worry that you may suddenly find that, well, hey, some rival who's bought Trump family crypto will get your business ruined. So in that way, the U.S. is not what it once was. But the idea that there's going to be a imminent plunge in the dollar, which the dollar is, it's down, but it's not all that low by historical standards. And the international role of the dollar is not yet under any significant threat. I wrote my first paper. Actually, it was for a conference in Rome, it turns out. But I wrote my first paper about the international role of the dollar and is it at risk for a conference in Rome in 1981. For you to say, this has been something that people go on about for a very, very long time, and it keeps not happening.
Okay. You mentioned Bitcoin, and I think you were on Bloomberg some days ago, and you said it turned out that the new gold is actually gold, not Bitcoin. Would you expand on that?
Okay. I mean, the idea, well, one of the arguments, so the Bitcoin has not actually found any legitimate uses. It's not a medium of exchange. You can't do business in Bitcoin. It's not a unit of account. Nobody sets prices in Bitcoin. The only way that the best argument for Bitcoin having enduring value was to say, well, look, everything you just said about Bitcoin is also true of gold. I can't walk in to a store with gold bars and buy a new refrigerator. So and gold has kept its value. Gold continues to be, in fact, the global value of world gold stocks is about 12 times the global value of all crypto. So it's a huge thing out there. So if Bitcoin could come to have that sort of psychological position that gold has acquired over the centuries, then maybe you can justify an enduring value for it. And that was the best argument that anybody could make. But if we look at what's happened lately, when people are panicked about the state of the world, they don't flood into Bitcoin. They actually flood out of Bitcoin and into gold. So that's what I mean. It turns out that gold is the new gold, and which I'm not sure that gold even makes sense. But if it always, again, I'm caricaturing, but it's actually hard to the whole thing is kind of a caricature. But if your vision is that the future is going to look like like Mad Max or Fallout or something. There's going to be this apocalyptic wasteland out there, and people are going to do business in bitcoins. Do you really think that the internet is going to remain fully functional in the post-apocalyptic desert? So it just doesn't make a whole lot of sense.
Yeah. In that scenario, my financial assets will be my last problem. Maybe we'll be looking for guns and gas and water.
Yeah, I mean, if you really are worried about the apocalypse, what you want is lots of canned food in your bunker, not.
Yeah. The last topic I'd like to cover is that I got into finance and economics during the great financial crisis. I was 21, 22 back then. Not exactly a great time to graduate, by the way. And I was both terrified and fascinated by the event at that time. And in 2008, the year you won the Nobel Prize, you were one of the key voicing during that mess. That was the time when the policymakers in the US decided, a little bit lately, maybe because of the US elections. Anyway, they decided to launch a massive quantitative easing and basically save the day. While in Europe back then was led by Angela Merkel, Germany, and they decided to maintain fiscal rigor, which turned out to be an error because the EU GDP now is almost a little more than half than that of the US, and back then they were almost the same. So
that's at market exchange rates. At purchasing power parity, there's been much less divergence than that. But yeah, I mean, but clearly the austerity, was there was a high price for excessive austerity in Europe.
Yeah, totally. The question is, at that time, I remember I read your "And is depression now?" In Italian, "Fuori da questa crisi adesso." This is the Italian title. And you advocated for stimulating the economy and not to maintain rigor during distress. Now you have in the US a ballooning debt, $38 trillion, and the deficit keeps rising. In your opinion, are we in a different territory now? And in case of a crisis, would you make different decisions now if you were to make one?
Okay, in crises, you do whatever you need to stabilize stuff. I mean, I don't think that. I earlier in this discussion, I gave some skepticism about quantitative easing, but the big expansion of credit between the fall of Lehman and the spring of 2009 was essential. If we hadn't done that, the whole thing could have melted down. It could have really been a 1931 style crisis. And we did it again, by the way. It's almost forgotten, but in 2020, when the magnitude of COVID became clear, there was a complete freezing of markets, which was solved by throwing lots of money at it. And again, I'm really glad we did that. And hopefully we will still be able to do that if there's another crisis in the future. But am I more concerned about deficits and debt than I was 10 years ago? Yeah. Partly because the numbers are big, partly because we are, we're running huge deficits when we're not in a crisis, which is not a good thing, and partly because interest rates are substantially higher now than they were, and that means that the burden of debt is significantly bigger than it used to be. Now, I'd like to see. I still think it's very hard to tell a story where we have an imminent fiscal crisis in the United States in general. If you borrow in your own currency, it's not impossible to have a debt crisis, but it's hard. It's really hard to find historical examples. I mean, people ask when I'm asked for an example of a country that borrowed in its own currency that managed to have a debt crisis from loss of investor faith, I end up with France in 1926. I mean, it's really hard to find cases where this has happened, but it's more something to worry about now than it was. The problem and I would also say, by the way, that Europe did learn a big lesson from the debt crisis in Europe. There was a lot of this is fundamental insolvency, and everybody must become like this Fabian housewife and all of that. And then it turned out that Mario Draghi said 3 words: whatever it takes. And suddenly,
whatever it takes.
Suddenly things got much, much better. And I think that people have absorbed that lesson, that it would be less panicky austerity this time around. But we, if you ask what I think we should do, I think the United States, I don't think the United States actually needs to slash its social safety net, but we need more revenue. We still have one of the lowest tax rates in the OECD, and we need at least to control some of the largely wasteful parts of spending. U.S. healthcare costs could be massively reduced without really cutting on people's healthcare. So, it's easy to talk about what we should be doing because politically there's not a chance that we'll do any of it for more than 3 years. So, and Europe is again, I mean, it's an interesting thing because Europe does have things are less extreme in terms of the fiscal imbalance, though they're serious. And the European economy is still in a situation where, at least, or was a year ago, where some fiscal boost can help. And I'm not going to say that I'm actually glad to see that among other things, the Germans becoming less rigorous. And actually, there's a really clear case where they had self-destructive austerity imposed on themselves because they kept the Schwarze Null in place, but meanwhile allowed their infrastructure to go to hell. It's still incredible to me that the trains are worse in Germany than they are in Britain. So actually, and way worse than Italy, which is one of the astonishing things about visiting your country. But anyway, so it's unfortunately, given where we are in world politics, the fiscal issues are sort of they're in the saved folder until we get past this current political crisis.
Yeah. Professor, last question, I promise. This is a podcast about long-term investing. We talk a lot about economics, but it's more about investing for the long run. And in the long run, are you long or short the U.S. economy and the U.S. democracy?
Oh, my.
Yeah, difficult one.
Well, no, I am short democracy, although not as much as I was a few months ago. Obviously, I'm deeply immersed in the U.S. political scene, and what's happening now would have been inconceivable if you talked to people 2 years ago. This is where we'll be, and this is what will be happening. Then I would have, people did dismiss even partial visions of what's actually happening as being crazy. Conspiracy theory and wildly alarmist, and it's turned out what's actually happened is beyond what the alarmists ever said. But it's also turned out that the American people are better. Our political class, our oligarch class, are worse than anyone imagined. But our general public is better than anybody imagined, and I'm actually feeling a lot more hopeful. But still, do I think that if someone were selling options on will the United States still be anything like a functioning democracy 5 years from now, I would still probably, I think that we may be slightly better than even odds, but not by a lot. So it's really, really bad. What does that say about investing? I don't think about that too much. I mean, I do think that the kind of extreme arbitrary crony capitalism, that would be the big argument against investing in the United States. How would be that you're living in a world where if your ability to invest in the United States depends on your ability to sufficiently enrich the president's family. Incredible that we're in that position. don't think that will last. I think that when current management passes away, or it's either pushed out or it passes away, that there will be a kind of demand that things be regularized a little bit. I mean, Hungary is not a terrible place to invest. It was a huge cautionary tale about the risks to democracy, and remains so. Although the United States has been far worse in the past year than Orban ever was, but it's not a nightmare for business investment. And in the end, I think the United States will probably be regularized. And there's a great deal. This is Adam Smith. There's a great deal of ruin in a nation. It takes a lot. I mean, you can really destroy a lot of our ideals without necessarily destroying investment returns.
Okay. Thank you so much for your vision, for your time. It was a remarkable conversation.
Well, thank you.
Bye-bye.
All right. Bye. Take care.